Hey everyone, let's talk about investments and continue our discussion of fixed income. Now that we know the relation between the price of a bond and its yield to maturity, which of course is related to the prevailing interest rate, let's think about what else we can say about the evolution of interest rates in the future. And let's begin with forward rates. So, what are forward rates? Well, first of all, the idea that interest rates change over time, we should already be familiar with. We found out what effect changes in yield might have on the bond's holding period return at price, of course, in the prior discussion. So now let's think about what we might be able to say about the rate for a one-year loan, but not right now, a one-year loan starting next year. Indeed, can we actually create a strategy that would lock in a certain rate to either borrow or to lend for 1 year, but not right now, in the future? And can we therefore make a guess about what the interest rate for a one-year loan in the future might be? Well, the answer turns out to be that we can. Let's differentiate between what the interest rates now and in the future may be. With two bits of terminology, we'll call a forward rate the interest rate that we can observe today, but will apply to a loan that begins at some time in the future, whereas a spot rate is the interest rate we observe today on a loan that begins today. So let's say that today we observe two zero-coupon bonds. They're identical in terms of the issuer. We can maybe think of them as treasury bonds. One of them has a yield to maturity of 2%. That's a one-year zero-coupon bond. And another, a two-year zero-coupon bond, has a yield to maturity of 3%. We can think of these as spot rates, right? That means that we can right now either borrow if we issue these bonds or lend if we buy these bonds. For 1 year, the rate is 2%, and if we want to borrow or lend for 2 years, it looks like we can get 3%. But let's say that we actually do want to invest or borrow for 2 years. Now, we can indeed just take that 2-year zero-coupon bond and hold that until maturity. That'll accomplish our goals of being either invested or borrowing for 2 years straight. Or we can actually use the 1-year zero-coupon, and after that comes due, either if we were the borrower, we would need to borrow again a year from now, or if we were an investor, we would need to buy another bond and lend at a different rate a year from now. Now, intuitively, we might expect these options to give the same total return, but that's not something we should take for granted yet. But what return would we actually expect if we actually do follow alternative 2? In other words, we try our luck with borrowing for 1 year and then reinvesting again, borrowing at a future rate for another year after that. Well, if we think about what the price of the 1-year bond is going to be at the end of that first year, well, we knew that its present value was essentially its face value of 100 discounted at its yield to maturity, 2%. And therefore, if we now compound it at its yield to maturity of 2%, we of course should get that face value back. So it shouldn't surprise us that the price of the 1-year bond at maturity is actually its face value of 100. Now, what would happen if we held that 2-year bond for the first year? Well, if it earns the same return as the 1-year bond, then we should expect, if its initial price was 94.26. We compound it forward at 2% for 1 year, and we get 96.14. Now, at maturity, of course, this bond is again going to be worth 100 because it's going to pay off its face value. So that means that in the second year, we're effectively locking in, or well, we're expecting a higher rate of return of 4%. Because for that second year, the bond's value at the beginning of the year is going to be 96.14. At the end of the second year, its value is going to be 100. Therefore, that means that its holding period return, as you can see, is going to be 4%. So this is what we mean by a forward rate, the rate that's sort of implied by the rate you can get currently to borrow for 1 year or lend for 1 year, and the rate that you can get for 2 years. So we can use what the current rates actually are to calculate what the implied interest rate for future years may be. And this is super important for fixed income because remember, the cash flows are set. Really the only thing that then matters is what the discount rate might be. So the more we can learn about the discount rate, the interest rate, the yield, the better off we'll be. So let's look at an example of how we can actually show that this is always going to be the case, how we can actually lock in this rate of 4% a year from now. All right, so let's say we have a 1 year zero coupon right now in time zero that has a yield to maturity of 2%, a 2 year zero coupon that has a maturity of 2 years, that has a yield to maturity of 3%. How can we trade in these 2 zero coupon bonds right now in time zero to actually create a synthetic forward loan during year 2, that is at the end of year 1 to the end of year 2. In other words, if we have a certain amount of money, let's say $1 million to invest between the end of year 1 to the end of year 2, how can we do it? Well, right now in year 0, we don't have any money, so I guess we better get some. Now, if we know we're going to have $1 million to invest at the end of year 1, what we can do is we can actually use the 1 year zero coupon bond to borrow against that 1 million. So let's actually then sell the 1 year zero coupon right now with a face value of that $1 million that we're going to get to invest. Now, how much can we get for it right now? Well, if the face value is $1 million, the present value is going to be that $1 million discounted at the yield to maturity, 1.02, for just 1 year, so 980,000. That's what we can borrow in year 0, and let's then invest or buy the 2 year zero coupon at that 3% rate. So if we invest 980,000 in the 2 year zero coupon, what are we actually going to have in 2 years' time? Well, we're going to take that present value, we're going to compound it at a 3% yield to maturity for 2 years. And that'll get us 1,040,000. So that's our trade in year 0. What are we going to do in year 1? Well, now this 1 year zero coupon that we borrowed is going to come due. And it means that we're going to have to repay $1 million. Now, thankfully, we will, at that point, receive that $1 million that we initially wanted to invest. So we can do exactly that. We can pay off our loan. And then in year 2, we can liquidate our position in the 2 year bond. Remember, now it's going to actually pay off its face value of 1,040,000. So then what is our return between years 1 and 2? Well, we got our $1 million that we wanted to invest. It turned into $1,040,000 by the end of year 2. So our holding period return would be the ratio of those two minus 1, or 4%, which is exactly what we wanted. So that's how we can engineer a forward rate between years 1 and 2 by making trades in the 1-year and 2-year zero coupon bonds right now in year 0. So as we can see, forward rates can actually be created through a trade in zero coupon bonds at different maturities. And indeed, we can generalize this relation that we observed in 1-year and 2-year bonds to multi-year bonds. So let's look at the general formula. We can say that the forward rate at any time in the future t is going to be a function of the yields that we observe, the spot rates, a bond maturing at the end of year t, and the spot rate, the yield for a zero coupon bond maturing a year prior to that. So if this t minus 1 stuff is a little confusing, just substitute in 2 for t, and therefore 2 minus 1, 1 for t minus 1. And there we get that same relationship that we were working on in the previous example, where the yield for the 2-year loan is actually essentially compounded for 2 years, but that should be equal to the product of the yield that we get on our 1-year investment, and then multiplied or compounded at the yield that we get for our next year's investment, which is of course going to be at whatever the forward rate for the 2nd year actually is. To visualize that, we can essentially think of it as our two alternatives. We can either lend for 2 years at the 2-year spot rate. Of course, remember, since we're lending for 2 years, we're going to compound the per year 2-year rate twice, and that'll get us to the 2-year horizon. Or we can first lend at the spot 1-year rate till the end of year 1, and then we can reinvest and lend at the forward rate that will occur through year 2, beginning in year 1, ending in year 2. What is going to be our total return on that investment? Well, we're again going to compound. Here's the yield that we will earn in the 1st year. Here's the yield we will earn in the 2nd year. And here is where we end up. And in that our example that we observed just a little bit ago, we can actually say that we can therefore lock in what this forward rate will be by trading the 2-year bond relative to the 1-year bond. And this example generalizes to bonds of different maturities quite readily. So let's say that we have a time series or a plot of zero coupon bonds at different maturities of years 1 through 4. They're issued by the same entity. Let's say it's the US government. And each of these zero coupon bonds maturing in years 1 through 4 have different but known, because these are currently observed prices and therefore currently observed yields. Now, using this, can we actually back out what the forward rates in all future years will be? Yes, we can, by using that exact same formula, relating the price of a bond maturing next year, the bond maturing the year prior to it, and therefore pinning down the forward rate in that last year. So what's the forward rate in the 2nd year? Well, that's an application of the formula just as we saw it previously. We're going to take the yield for the 2-year bond, we're going to compound it twice, and we're going to say that the forward rate must be what you would get if you invested your money in the 1-year zero coupon bond and then compounded it at the forward rate for the next year. Rearranging, solving for the forward rate, that means that our expected forward yield for year 2 is going to be 4.8%. What about the forward rate for year 3? Well, the idea is analogous here. We can say that either we can lend at the 3-year rate for 3 years, or we can lend at the known 2-year rate here for 2 years, and then compound that investment at the whatever the 3-year forward rate happens to be. That means that we can then pin it down using this formula, and that turns out to be 6.1%. And finally, if we want to lend for 4 years, well, one way that we could do it is we could lend for 4 years, compounding for 4 periods at the 4-year yield of 5.6%, or we can lend for 3 years at the 3-year yield of 4.7%, and then for 1 more year compound that at the year 4 forward rate. And again, we can pin down what that is. Using this formula, that seems to be 8.3%. So this is how we can actually use prices and therefore yields of zero coupon bonds to estimate what the interest rate in the future is going to be like. Any number of years ahead, provided we actually have bonds maturing at the beginning and the end of the year, the rate for which we are curious about. So that brings us to a discussion of the term structure of interest rates. Now that we sort of see how interest rates can be expected to evolve through the future, let's actually see what we can learn about what the shape of interest rates in the future can actually tell us. So this plot that we saw in the example 2 slides ago, a collection of zero coupon yields to maturity across different maturities, goes by many different names, but they all get at the same idea that you have essentially a plot of expected interest rates at different maturities, and therefore you can even learn about what future interest rates for individual years in the future may be. So this collection of yields to maturity across different maturities can be called the term structure of bond yields, the term structure of spot interest rates, because remember, since all of these yields are based on prices that we observe now, these are spot rates, rates that are available right now, or the yield curve. And historically, if we think about the shape of this yield curve, because we can literally plot this out, as we'll see on the next slide, we can literally plot what the yield relative to maturity is. Most often we'll actually see an upward slope, which is to say the longer the maturity, the higher the yield. But sometimes we might actually see a reverse relation. There might be a downward slope. Sometimes there's going to be a flat one. In other words, the yields at different maturities are all the same. And interestingly, sometimes they can actually be hump-shaped. In other words, it can be higher in some parts and then lower in others, or vice versa. The most common way to measure the slope of this yield curve is to look at the difference between the 10-year rate and the 3-month rate. So we may want to think about, as we go ahead, what actually can cause the term structure of interest rates to be upward and downward sloping. what could cause a potential hump shape in it, and why actually it would vary at all. So here's an evolution of yield curves. You can see the 10-year rate and the 3-month rate highlighted in pink over a period of time from the Financial Times. And you can see that for a while in 2018 it's upward sloping. The 10-year rate is above the 3-month rate, but then at one point toward the end, or I guess toward the beginning of 2019, we can actually see that it becomes inverted. And the 3-month rate is actually a little bit above the 10-year rate. So in a way, we observe quite a few of these behaviors. There's an inverse hump shape, there's an upward slope, and toward the end, there's also a downward slope. So what can actually determine the shape of the yield curve? Well, there's 3 important theories that we'll go through that have been advanced. The first is an expectations hypothesis. In other words, people simply look at the term structure of interest rates. They sort of back out, analogous to what we did in our example with forward rates, what the implied future interest rates will be. A liquidity preference theory where this is also modified to account for a potential preference for shorter term. Remember, as we talked about in the financial assets lecture, more liquid bonds. People may not really like holding their, locking up their assets for as long with long maturity bonds as they could avoid by taking a position in short-term bonds. And segmented markets where there's just simply some types of investors that will actually hold positions in bonds of different maturities, perhaps for portfolio reasons or other investment objectives. And these 3 really present facets of thinking about what might be driving the term structure of interest rates. So the reality is probably driven by all of these, perhaps more by some than by others at different points in time. So let's go through these one by one. The first, the expectations hypothesis, starts with a few assumptions. So the first assumption is there's no transaction costs. We can buy and sell bonds without paying a bid-ask spread, without paying really a distortionate commission. Furthermore, these bonds will pay off, so they're going to be default-free. But if we think about the term structure of interest rates on, let's say, US government debt, that's a reasonable assumption. That investors actually are risk neutral. In other words, all they care about is profit. They don't really care about risk, fluctuations in yields, and therefore fluctuations in holding period returns. They really just care about the expected return. Bonds are zero coupon bonds. Well, that's fine for building a term structure of interest rates. It may be more difficult to approach the same thing with coupon-bearing bonds, but the good news is that we can always look at zero coupon bonds to do this. So because of risk neutrality, essentially we're saying that investors will choose the bond of their preferred maturity just based on what will maximize a holding period return. So the claim that we're going to make is something that should look somewhat familiar. We're going to say that the 2-year spot rate is going to be, if we compound that for 2 periods, or alternatively, if we discount this at 2 periods, this right-hand side example, if we bring in the square exponent over to the right-hand side as a 1/2 exponent, essentially what we're saying is that the 1-year rate and the expectation of the 1-year rate a year from now is going to be the same thing as the compounded 2-year rate for 2 years. And this is, of course, very similar to the relation that we use to derive the forward rate. The notation is a little bit different because now we're going to work with different time subscripts. So we're going to say that the yield is going to have 2 inputs. There's going to be the time subscript. Time t means right now. T plus 1 would be a year from now. And the input in parentheses will be the maturity for the particular yield. So for example, yt in parentheses 2 is the 2-year spot rate, 2-year maturity, today, aka spot. Analogously, yt in parentheses 1 would be the 1-year spot rate, because again, it's observed right now in time t, and it is for 1 year ahead. And the reason that this subscript t is important, because now when we want to think about the expected interest rate in the future, that will actually be an expectation. The E sub t is the expectations operator from statistics. That'll be the expectation a year from now for a yield of 1 year maturity. And we're actually going to prove that this relation will hold. And one interesting thing that we will observe is that expected holding period returns are equalized in equilibrium. So you can either go with the approach of investing at a 2-year spot rate right now, or you can invest at the 1-year spot rate now and then at whatever the expected 1-year rate will be in the future. In both cases, you should get the same return. And therefore, the typical shape of the yield curve will actually be flat.